All right, good Tuesday morning, 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, the U.S. and Russia agree to more talks on resolving the war in Ukraine, but they set no date for a summit meeting between Donald Trump and Vladimir Putin.
Legacy tech is back. Cisco, IBM, and Oracle are outperforming this year, showing old school tech names can be AI winners as well.
Plus, Big Pharma heads to the White House. CVS Health executive Prem Shah joins the show as the company pushes back on critics in the fight to lower drug prices. All of that and more coming up. Let's take a look at where markets are trading right now in this holiday shortened week. You can see a little bit of a lift following on that momentum that we picked up on the big indexes last week. The S&P 500 higher by about 0.4%. Same story too if you take a look at big tech, with the Nasdaq 100 higher by 0.5% pre-market. Can't say the same about the bond market. We're seeing a sell-off there. 10-year Treasury yields higher by about 4 basis points, back above 4.5%. Matt Miller, it doesn't feel like it, but actually Treasury yields have been falling for 5 weeks straight on the long end. Maybe we'll see a reversal this week.
Yeah, we're still just slightly in the danger zone there.
Slightly.
At 451.
Slight danger.
I'm showing a chart here of the outperformance of other indexes over the S&P 500. S&P here, total return in yellow. I show it in total return because that's how the DAX is calculated. You can see the DAX here in white. The German benchmark index, this is year to date, outperforming the DAX. Here in the middle, you see the Stock 600 for a broader look at how European stocks are doing. But this is just one more sign that investors are willing to take risk outside of the U.S. Maybe that the idea of U.S. exceptionalism is dying down a little bit.
Yeah, maybe we hit peak U.S. exceptionalism. We will see. Looking also at some stocks under the hood here that are moving. We're looking at Intel. This has been a mover for really some time now, but up more than 4.7% pre-market, gaining this morning. The stock had had its best week since the 1980s. Last week, extending gains now. Remember, there's also a report that TSMC and Broadcom are looking into deals that would bring U.S. chip-making giant. It would break it in two based on the deals it would have with both of those companies. Also looking at Constellation Brands here, a 5.6% pre-market. They are surging. It was 13F season. Berkshire Hathaway reported a new stake in the beer giant. And H&E Equipment Services, we're looking at deals as well, up more than 13, almost 14% pre-market. They have accepted a bid from Herc Rentals, which values the group at almost $5.3 billion, according to the Financial Times.
All right, so a lot going on in the stock market this morning. There was a great survey out by Bank America showing that investors are piling into global stocks. Cash levels are the lowest they've been since 2010. But I thought, Katie, very interesting, 89% of the respondents in the survey said that U.S. equities are overvalued now. Yeah, and it
matches really well with that chart that you just showed, that somehow Europe is outperforming the U.S. year to date. And I say somehow because you think about the story coming from Davos. It was about all these depressed Europeans. We have all of this geopolitical strife when it comes to Europe right now. But apparently the U.S.'s rich valuations are something to be scared of.
It's interesting. You have that Bank of America survey saying that investors are long stocks and short everything else. But then you look at where they're buying, it is pretty defensive. It follows that kind of short trade in a different way. Gold, in particular, that Goldman note this morning, for example, saying that you could have gold hitting $3,300. The reason that's interesting is starting last year, it was below $2,000. So incredible rise already. They expect more to come. And part of that, Katie, is because of all that buying into ETFs.
Well, speaking about interesting Goldman notes, did you see also that they're raising their MSCI China target on the DeepSeek news? They're expecting a 16% rise in Chinese equities over the next 12 months. It's been a while since we've talked to a China bull on this show.
Yeah, absolutely. By the way, I think the Goldman target is 3,100.
As much as 33, though. The target is 31, but they can go into 33.
I see, in a best case scenario.
They've got a base case, they've got a bull case.
Or a worst case scenario. All right, let's get into the geopolitical story.
That's, of course, some of the reason why people are looking for haven bids. Remember, top U.S. and Russian officials have met in Saudi Arabia to discuss ending the war in Ukraine, but without Ukraine's participation. And Bloomberg's Oliver Crook is covering this for us. Plus, I've been watching, Oliver, you've been covering global news kind of really really across Europe right now, a lot going on at the same time. But let's stick with what's happening in regard to Ukraine. How does the matter evolve from here, particularly as the tensions keep brewing between the involvement of Ukraine's discussions with the U.S. and Russia?
Yeah, so listen, I think that there was a sort of very truncated timeline that just sort of suddenly appeared out of the clear blue sky last week, where we basically understood that the Trump administration was seeking to actively meet with President Putin after the phone call that they held last week. And those are the beginnings of those sort of preparations for that conversation of a sort of one-on-one in-person meeting began this week in Saudi Arabia. We had Marco Rubio, we had Mike Waltz, we had Steve Witkoff, all there. You can see them around the table sitting across from Sergei Lavrov, the foreign minister of Russia. This is a sort of concept that probably a couple of weeks ago was more or less inconceivable, and is a sort of concept that is still fairly inconceivable to many of the European leaders here who are observing this, and they're observing it from a distance, not really involved in any of these conversations. However, after that meeting concluded, we had heard going into this meeting that Trump was potentially hoping to meet Putin as early as next week. We understand that that timeline may not be really very accurate, and that it seems, from what we've heard from Russian media on the sort of on the back of that meeting, that it probably is not going to happen next week. But again, this is a fast-moving question, a fast-moving story. Of course, the Ukrainians were not involved. I think for the Trump administration, this is just really a fact-finding mission to see how strong the cards that they hold are at the moment.
Yeah, a lot of moving parts here, like you say. You raised two interesting points. One, that, of course, Volodymyr Zelensky has warned that his country won't recognize any agreements about us without us. So that, of course, is a hurdle there. But I want to talk about the U.S.-Russia relationship and whether they were on the same page when it comes to the goals of this meeting, because it seems like the U.S. side was trying to start negotiations here about an end to the war in Ukraine, whereas sort of the message coming from Russia was that this was just about normalizing relations with the U.S.
Yeah, and it's felt a lot like the Trump administration has wanted to sort of dictate the cadence of what this discussion would be like. And again, what we got from the sort of Russian side is that perhaps not so fast. Maybe that's not exactly how it's going to go. So again, I think we're going to have to leave a little bit of time to digest what each side really heard from the table. But we need to imagine in kind of the mind of Donald Trump and the mind of Vladimir Putin what each of them sort of hopes to extract from this meeting. As sort of upset and as sort of concerned as the Europeans have been that the Trump administration has sort of moved on without them into beginning these conversations, the real question is, I mean, everybody wants a good deal here, right? And what that means for Russia and what that means for the United States, we still don't really know. Obviously, the Russians want to hold on to some of the territorial gains they've made in Ukraine, but really the one thing they want is Ukraine to be sort of guaranteed to never join NATO. These are all of the chips that are on the table right now, and frankly, the reality of the situation is we don't really know what the U.S. administration wants from Russia. We start to have an idea of what they want from the Europeans. They want the Europeans to step up their role in terms of security guarantees, maybe deploying troops into Ukraine in order to have a peacekeeping mission there after any kind of talks. But those are the kind of state of play going into this conversation.
Yeah, it'll be interesting to see how many of those peacekeeping troops are actually European boots on the ground, specifically German boots on the ground. Oliver, great coverage there out of Berlin. Oliver Crook covering this for us. Let's get to the market side of it. BMO Private Wealth Chief Market Strategist Carol Schleif joins us now. And Carol, clearly we've seen the rise in defense stocks both in Europe here in the U.S. But I think it's interesting as we see kind of a peaking of optimism in terms of stock market investors that people are favoring European assets over American ones. How do you think about that?
I think a piece of it is that there is the relative valuations, and when you look at it at a short-term standpoint in terms of year to date versus it neutralizes some in terms of how badly a lot of the global markets underperformed in the last couple of years. But you're seeing people want to keep that growth stance, if you will, and watching the rest of the globe, not, other surveys out assuming that people don't see necessarily pullbacks in the rest of the globe, that there's reasonable growth. And in the U.S., companies in particular, as well as investors, are grappling in the very short term with how do we get clarity around the tariff issues, who, what, where, how much. We've got some key dates coming up with March 4th, March 12th, April 1st. But once we get beyond that, we do think investors stay on that foot forward, if you will, and that the U.S. economy is still in pretty reasonable shape. But we're paying pretty dearly for it.
Speaking of paying pretty dearly, another thing that caught my eye about this Bank of America survey this morning that we were talking about was that fund managers' cash levels fell to the lowest levels since 2010. We talk about this all the time, all the cash on the sidelines as it pertains to retail investors, particularly when you still have higher interest rates, cash can still pay. But if you have fund managers where cash is harder to come by, then how much is this market really depending on that marginal retail buyer?
Well, there is that piece of it, but you've also got a philosophy. There's the ongoing debate, if you will, among professional money managers. And there are a lot of them that feel like their job is not to hold cash for clients. Clients will hold the cash that they want to hold outside of what the professional money managers do, and that professional money managers are paid to be fully invested. So they're looking around the globe for those areas that might not have participated as strongly coming into this. So there's a lot of hunt. It was pretty interesting last year because Chinese markets did well, actually, and surprised a lot of people with the strength towards the end of last year. You've got great growth numbers coming out of Japan in the last week or so in terms of the economy and inflation coming back to reasonable levels. So it is a pretty interesting global mix.
Yeah, it's a great point, too, on money market funds, because it's not the job of these professional managers to hold cash. That's what their clients are doing. And you can see that in money market funds, still at $7 trillion thereabouts. But let's go back to China. We were just chatting about that Goldman note, basically upping its target on Chinese equities, thinking that this DeepSeek news from a few weeks ago, it's not just a flash in the pan. Talk us through your base case, though, when it comes to China.
I think the other thing to think about, too, and one of the things we've been migrating towards in China is that our house view has been leaning towards China in that, assuming that President Trump was wanting to cut a deal with China relative to tariffs, because there were a lot of things on the campaign trail thrown out there, but he's also expressed a lot of appreciation for Chairman Xi and what's gone on over there. And so we suspect that a lot of the verbiage that you've seen out there is positioning for a trade deal. And if you get some kind of deal relative to tariffs so that people know what the playing field is, then companies can adjust, then people can move on. And so we do think there's a lot more opportunity in Southeast Asia, if you will, just based on, you do need to see some supply chains rearranged, but that's happening, and we suspect that there's so much pessimism in some of those markets, and it bears over into the developed markets in Europe as well, that there's so much pessimism in those markets that hopefully there's some room from a valuation standpoint.
All right, Carol, thanks so much for joining us on such a news-packed day. BMO's chief market strategist for BMO Wealth, Carol Schleif there. Coming up, old school tech names are making a comeback in 2025. We'll take a closer look at the AI race next and how it needs old economy companies as well to help build the infrastructure. This is Bloomberg. Let's get out of high interest to look at what's making headlines around the world. A report from the Financial Times overnight says the Japanese auto giant Honda is willing to resume takeover talks with Nissan if the company's CEO steps down. The report says that Honda would be prepared to revive negotiations under a new boss who can better manage internal opposition. And Delta Airlines, a plane from the airline flipped upside down while landing in windy conditions in Toronto yesterday. The plane, which was flying from Minneapolis-St. Paul, had 80 people on board. 15 were injured, 3 critically in the accidents, the latest in a series of plane crashes so far this year, including the deadly crash in the Potomac River late last month. And here in New York, Governor Kathy Hochul is signaling she may use her authority to remove New York City Mayor Eric Adams from office. Hochul is calling a meeting today with key leaders to discuss a path forward. 4 top officials in the Adams administration resigned following the fallout over the Justice Department's decision to dismiss corruption charges against Mayor Adams, and those are just the latest in a longer line of resignations. Katie?
Yeah, we'll continue to follow that story closely. But switching gears here, score one for the boomers. Legacy tech names like Cisco, IBM, and Oracle drawing renewed attention in the AI tech race. Bloomberg's Ryan Vlastelica wrote the story. He's here with more from Chicago. We were talking about how surprising it is to see Europe outperforming the U.S. year to date on valuation concerns. More surprising maybe is the fact that you have Cisco, IBM up double digits so far in 2025. What is going on here, Ryan?
Hey, good morning. Thanks for having me. So a few things going on here. It seems like after an extended period where these companies were seeing sort of lower, slower growth trends, they're starting to participate in the AI trade in a more concerted fashion. We saw this with Cisco last week. Pretty strong forecast there. It is starting to participate from all of the buildings surrounding AI infrastructure. IBM, its software business, its cloud business, that is also seeing renewed demand. That's helping lift growth up. It's not quite as strong as you're seeing among the the more familiar names that we talk about within big tech, but it's starting to pick up a little bit. And the fact that these stocks were beaten down for a pretty long period of time, pretty cheap relative to the other names within big tech, dividend yields, so on and so forth, that's helping attract a little bit more of a renewed attention so far this year.
Well, one thing you point out in your story also, that the idea that they trade at only 17 times earnings for Cisco, much less, for example, than the Mag 7 over 30 times. Do you think that there's a lot of room here for expansion, to look closer to the Magnificent Seven if they're really going to benefit in these serious ways from AI? Really, how much room is there to run?
Well, I'd say for Cisco's example, the growth expectations there are not nearly as strong as you see at Microsoft or Amazon or Nvidia, so on and so forth. So it probably doesn't have the room to get to that kind of multiple there. But certainly it is lower now, and the growth is starting to accelerate just a little bit. So certainly some positive trends there.
I wonder about Intel. Okay, it's not necessarily one of these old economy companies, although it feels like it to me.
An American icon, if you will.
It is an American icon.
Thank
I mean,
you.
let's face it, it's old school, right? That's been the problem with Intel. However, Ryan, we've got reports now that Broadcom and Taiwan Semiconductor are considering different plans. Is it back in play, Intel? Is there a possibility this company gets bought or broken up?
It seems like such an increasing kind of outcome here. Obviously, the CEO was removed, I think in December. He was someone who was really forcibly trying to keep the company's initial plan of having both a foundry business and a chip design business intact. He was very, investing a lot in a turnaround. It seems like they were really struggling with that turnaround, spending a lot of money, having sort of less to show for it, especially in the AI age. So it does seem like there is increased interest right now in, some kind of outcome where either the company is split up or acquired. We really don't know right now. It's pretty up in the air at the moment, it seems like.
Yeah, speaking of up in the air, it's interesting, guys. You looked at Bloomberg Intelligence research. If they do get away with this investment, you have TSMC risking profitability on a lot of metrics also. So even for the other companies, there's kind of a lot to sort out in terms of how capital intensive this might be.
Yeah, it's a gamble on both ends. It really feels like this market, this trade wants to see something happen with Intel, whether it's a breakup, whether it's a deal. We'll have to continue that. But Ryan, I want to talk a little bit more about this broader theme, that you do have these older, more mature companies now getting in on the AI trade, feeling some of that enthusiasm. Do the fundamentals match up with that, or is this more a valuation game, just looking at what is undervalued right now relative to, of course, the Magnificent Seven?
Well, I'd say a year ago, people really weren't paying much attention to IBM or Cisco, kind of in general. I mean, occasionally they would benefit as in sort of these temporary sort of value trades or dividend trades. But I would say right now we are seeing a little bit more of a growth narrative surrounding AI, which is helping these stocks. It's not as strong as you're seeing at some of the Mag 7 stocks, but again, the valuations aren't as strong, so it's allowing them to play catch up in a little bit.
Yeah, it's allowing them to take advantage of a place where maybe they've lost a step, right? I think of IBM, and they continually try and innovate in the AI world, even before it was a hot term, when they were beating human contestants on Jeopardy. Do they have a chance at doing something better? Do people really see their products or their software as innovative?
I think you're seeing that to a certain degree. I don't think anyone is really viewing them as sort of the cutting edge in the same way you might, the OpenAIs of the world or some of those, larger players here. But the fact that they are starting to see some improved growth, some improved cloud trends, some improved networking demand, all those kinds of things, especially off of a lower level, has people taking a look. Maybe some of the bigger Mag 7 stocks have already, gone a few innings in their AI story. Maybe the IBM or the Ciscos of the world, maybe they're more in their first inning or so. And that allows you to sort of get in on a lower floor. Might be the theme here.
Ryan Veselica, thank you so much for your time and for your reporting. Of course, fascinating read this morning and very fun time looking at these stocks.
Yeah, absolutely. Also, IBM, I just find it really charming that the name is International Business Machines. Nothing screams more to me that this is an older company from the 60s than the name International Business Machines.
They need a hotter name, like a fruit or something.
They got to get AI in there somehow.
I know a guy who works at IBM up in Armonk in machine learning.
There you go.
So that is,
They do machines internationally.
Well, machine learning is AI, right?
Oracle is kind of futuristic.
Yeah, that's true. That's a flashy name.
Yes, and of course, Larry Ellison hanging out with President Trump and Dan Altman at the White House doesn't hurt things at all. We're going to continue to discuss this AI trade and more with RBC's Lori Calvasina. We'll talk to her as well about the Bank of America survey showing global stocks are favored and investors are willing to take more risk than they have in the last 15 years. This is Bloomberg.
Welcome back to Open Interest. Let's get a check on these futures. Minutes to go until the bells ring. You can see a lift to these markets continuing on the momentum we found last week with the S&P 500 higher by about 0.3%. The NASDAQ 100 higher by about 0.5%, coming off of its best week of the year. There's only been 6.5 weeks, but even still continuing that rally today. And the Russell 2000 also getting in on the action, currently higher by about 0.2% on those small caps. Now, coming up with less than 4 minutes to the opening bell, we'll discuss the market moves with Lori Calvasina of RBC. That conversation up next. This is Bloomberg.
Getting ready to hit an all-new record high on the S&P. This is Bloomberg Open Interest. We're just about 10 seconds away from the opening bell. You can see futures here up 0.2% on the S&P, up about 0.3 on the NASDAQ, and up 0.1 on the Russell as well. So we were almost there at an all-time record high. May have hit an intraday on Friday, but didn't close there. Of course, yesterday was a day off to celebrate the presidents of the United States of America, the previous ones. And we have the opening bell. Prudential is celebrating its 150-year anniversary. Have they been listed for 150 years? I don't know if they've been listed that long. Over the last 5 years, they have returned 52%, including reinvested dividends. Not bad for an insurance company. And then Iller is the ticker for a company called Triller. I had never heard of it, but apparently it's a TikTok rival. And I looked back to see President Trump used it when he first got kicked off of other social media platforms. And his last post was excoriating, ripping apart the protesters on January 6th. Now, I guess they're okay. But it's very interesting that they're ringing the bell there. The stock down 92% in 5 years, but it was a SPAC. So that's how those things happen sometimes. Katie, what do you see in terms of the major averages?
First of all, that was a great vocab word. I would not even know how to spell that, but you take a look at the major averages, we're kind of losing the steam that we saw building in the pre-market. We still have green on the screen. The S&P 500 up about 0.1%. That was closer to 0.4% just about half an hour ago. Same story, too, if you take a look at big tech in the NASDAQ 100, now higher by about 0.3%. Of course, the big tech benchmark is coming off of an almost 3% gain last week. We'll see what catalysts we have on dock in this holiday shortened week. And then the Russell 2000 also losing its bid a little bit, currently higher by about 0.1% on the small cap benchmark. Let's look under the hood here and talk about Intel, though. As we've been speaking about on this show, it's been on a tear recently. It posted its best week since 1982 last week, and it's now higher once again following reports that TSMC and Broadcom are looking into deals that would split apart this chip-making giant. You can see traders cheering that along. Intel shares currently higher by almost 5%, Sonali.
And Katie, I'm looking here at Constellation Brands. Shares are on the up and up after Berkshire Hathaway reported a new stake in the beer giant. The 13F shows that Berkshire holds a nearly $1 billion position in Constellation. Pretty fascinating, Matt, because earlier this year, this was a company that was feeling some jitters against tariff talk. But of course, the Oracle of Omaha here, some confidence in the stock.
Yeah, concerns obviously about tariffs for a number of U.S. companies. Constellation Brand, no different. In terms of other movers that we have and interesting stories on the day, Nike is teaming up with Kim Kardashian's underwear label Skims, working on an extensive line of apparel for women under the creative name Nike Skims. It will debut in the spring.
Yeah, so put your pre-orders in now. I'm interested to see.
Do they not have Skims for men?
No, I think they do. I think
it's like Spanx, right?
It's is, but they're branching out as evidenced by this partnership. It is interesting to see Nike shares higher on this because you have to imagine that Nike already has fitness lines for women, but I guess, you know, if you're trying to make Nike cool again, maybe you want to partner with a
but those are all for people who are like fit, right? And this is for people who aren't fit to make you look fit. I thought the idea was to rein things in a little bit.
No, Skims is inclusive. Some of those dresses are really tight, so I think you want to be in shape.
I'm looking for a Skims IPO. That's what I'm looking out for.
Yeah,
all right.
More about Skims than it is about Nike sometimes.
Okay.
That's true. Nike shares up about 3% though. But let's bring in RBC head of U.S. equity strategy, Lori Calvasina. She joins us now. And Lori, we have a Bank of America fund manager survey out this morning. The headline there is that investors haven't been this risk on since 2010, but I wonder if you can say the same for CEOs, because you think about the tenor coming off these earnings calls and it seems a little bit cautious.
No, I think that's exactly right. And as we have gone through this reporting season, we've been reading week to week. We tend to think about it in batches for different weeks. And at the beginning of this reporting season, there was a lot of optimism. And we really heard about that from banks and financial services companies in particular. But as reporting season wore on, we got more and more allusions to the idea of uncertainty. And a lot of that uncertainty coming out of the policy backdrop. And we've heard a lot about that general uncertainty in recent weeks, but also about tariffs in particular. And so it does feel like companies are maybe not quite saying as much as they could. We had really expected coming into this reporting season, companies would be talking about how post the election uncertainty being removed, that there would be this big unleashing of animal spirits. We're just not hearing that. We're also not getting a lot of color from companies about consumers and how they're acting right now either. So it's been kind of a quiet reporting season with undertones of uncertainty, to be sure.
Fortunately, I get up early enough to listen to Nathan Hager in the morning. You were on with him as well on Bloomberg Radio, Lori. And I thought it was fascinating, your response to the Bank of America survey. So there's so many things to pick apart in that survey. But my main takeaway is 89% of respondents think U.S. stocks are overvalued. And you have this like incredible level of high valuations meeting this level of high optimism. How does that work out?
So, surveys and, all these sentiment gauges, it really depends on who you're looking at, and they can differ from time to time. I'll tell you, in terms of just the overall optimism, what we see on AAII is that net bullishness is now starting to go back down to levels last seen in 2023, 2022, some really kind of challenging periods in the market. If you look at the conference board gauge on whether stock prices are going to go up, I believe that's sort of been sitting around all-time highs. I think that may have come in a little bit. If you look at the CFTC FTC weekly data on U.S. equity futures positioning, it has been hitting all-time highs and is starting to ease. And I think that probably syncs up pretty well with that fund manager survey in terms of who it's looking at, more kind of the institutional side of the business. Now, on the issue of valuations, I will tell you, I was over in Europe and marketing some other places outside the U.S. back in December after we put our year-ahead outlook out, and I got an earful from international investors in particular about how overvalued the U.S. equity market looked. And sure enough, on my valuation modeling, I have a really hard time coming up with good math for the S&P this year. The best I can come up with is about 6,200. I'll spare you all those details.
Wow.
But if you look at plain old-fashioned forward PEs, whether you're looking at Russell, S&P X, kind of the Mag 7 cohort, equal weighted S&P, all those multiples are kind of hitting past ceilings and starting to retreat. So I think the market is also telling you there's just not going to be a lot of expansion this year.
What's also fascinating to me is if you break apart what's happening under the hood of the major indexes, you do have the NASDAQ outperforming the Mag 7 by and large, by a landslide, if you will. I mean, you have the NASDAQ up more than 5%, and you have the Mag 7 up 1.6% roughly on the year. If you look at the component parts of the NASDAQ 100, in the top 10, you only have one Mag 7 company. It's only Meta. But some of these other companies, Palantir, Constellation, they're not cheap by any metric either. How much do you have investors out there looking for a bargain or just following the herd? Because a lot of the companies that are performing well this year are still the companies that were performing well last year.
So I think the sort of tricky thing, right, is that if you look at, again, that top 10 cohort in the S&P 500 in terms of market caps, it's like Mag 7 plus a few extra. And you look at the rest of the market, you do a relative PE, and then you compare the relative long-term earnings growth of those two buckets. They tend to track each other, right? So we know that premium valuations are paid to companies that display premium long-term growth expectations. And there's nothing illogical or wrong with that. Now, I do think that as the market is broadening out, there's just not a whole lot that's cheap. Some of the sectors that investors wanted to pick apart in the year ahead discussions do look cheap, but it was things like energy, where there's, some concern about sort of supply dynamics and if you're really going to have support for the oil price going forward. So that one, I think that one's getting more generalist fans, but you can poke a lot of holes in that one. Healthcare, where there's tremendous policy uncertainty, has also looked quite cheap. So I have seen investors poke around, and take a hard look at some of those cheaper sectors. But I think you're hitting something on the head, Sonali, which is just the idea that it is very difficult to sort of find those true value opportunities. And some of those old winners, maybe not the Mag 7 in particular, but some of those old winners are still clinging on.
Well, do you look outside the U.S. for that? Because speaking of year-to-date stats and surprising facts here, the stock 600 is up about 9% year-to-date on a total return basis. You compare that to the S&P 500, only up about 4%. People clearly looking to Europe right now. Lori, would you chase that rally?
So look, I only cover the U.S. And I don't make calls in sort of U.S., non-U.S. But what I have told people, and again, this kind of goes back to my December trip to Europe. I didn't find a single person in a week, in like 5 or 6 different cities who wanted to buy Europe over the U.S. It felt to me like the most out of favor moment I've ever seen in my career for Europe. And that usually is telling you something. If you look at the funds flow data on EPFR that comes out every week, it has been showing moderating inflows to U.S. equity funds. And that's coming as passive is turning or trending lower again, rather active is turning negative, passive is kind of losing its momentum. And we are starting to see Western European equity funds reapproach positive territory. They're not really back in it firmly yet, but they're kind of flirting with it. And you've seen a clear improving trend. You've also seen the same thing for EPFR's data on Germany equity funds. So I do see some, signs of that geographical rotation. And what we do know is that over time, when growth is beating value within the U.S. tends to outperform Europe. And vice versa. When you see the market kind of broaden and the value trade come back, we do tend to see non-U.S. geographies do well as well.
Lori, great to have you on with us on Bloomberg Television after your appearance on Bloomberg Radio this morning. RBC's Lori Calvasina, thanks very much for the double duty. Coming up, pharma execs meet with the White House to discuss potential reforms and RFK Jr.'s priorities as health secretary, but pharmacy benefit managers won't be at that meeting. We'll talk to one of them, CVS Health's Executive VP Prem Shah, about where he sees U.S. healthcare under Trump's second term. This is Bloomberg.
All right, welcome back to Open Interest. Let's take a look at some breaking news we have here on the geopolitical front, and that is that Zelensky cancels his plan to visit Saudi Arabia on Wednesday. This headline just crossing, of course, just hours after the U.S. and Russia concluded their negotiations in Saudi Arabia's capital. And now the news coming that Zelensky has canceled his plan to visit Saudi Arabia on Wednesday, not having too much of an impact in the market right now. You can see the S&P 500 still higher by about 0.1%, gains of similar magnitude if you look down the board here.
It does look like he will go in March.
He will go in March, but not on Wednesday. So
right.
we'll continue.
Wednesday's not March quite yet.
That's true.
Wednesday is still.
So the week after.
The week after.
Possibly.
Well, March is a month long, so.
Yeah.
But as we know, other critical conversations are going on right now.
There we go. Let's have a critical conversation right now, because this week, CEOs of big pharma companies, including Pfizer, Merck, and Gilead, will meet with President Trump to discuss potential reforms in the sector. Now, who's not at the table this week? It's PBMs, pharmacy benefit managers. Those are the middlemen that are responsible for negotiating drug prices. Let's get some more insight now from a major PBM player, CVS Health. Prem Shah, he is the executive vice president and group president of CVS Health, and I'm pleased to say he joins us now. Prem, it's great to have you with us, and just set the scene for us briefly here, because I think this is an issue that confuses a lot of people. What role do PBMs play when it comes to drug prices? Where do you actually sit in the process?
Yeah, Katie, first off, thanks for having me on the show. PBMs, or pharmacy benefit managers, have been inside of the U.S. healthcare kind of industry over the course of the last 30 years. And they are a very effective tool to, one, serve the customers and clients that we serve. So if you think about pharmacy benefit managers, they serve 275 million Americans, and they deliver the benefits for them across the country. And their primary role is to administer those benefits and lower the cost of drugs inside of the supply chain. If you think about where drug costs come in the United States, if you look at the healthcare dollar, about 90% of the prescriptions in this country drive only 10% of the cost, and 10% of the prescriptions drive 90% of the cost. And so PBMs drive competition. They create services and solutions that help make prescription drugs more affordable in this country. And, they generate a lot of savings, right? We've proven our savings for the healthcare ecosystem,
right.
And over the course of the last decade, or over the course of the next decade, they will drive over $1 trillion of savings in pharmacy supply chain. So we're excited to continue to play our role. It's an essential element in the way we deliver benefits and drive down the costs in the U.S. healthcare system.
Well, talk to us about your relationship then with the Trump administration, because obviously we have CEOs from the big pharma companies meeting at the White House this afternoon, I believe. And you think about Trump's own words saying in December that he's going to, quote, knock out the PBM industry. What have your conversations sounded like with this administration?
Look, we're really excited about our conversations with the administration, and we're engaging with policymakers at the local, at the state, and at the federal level. And if you think about those discussions, they've been around, what's really going around in all of our own homes, which is around how do we make drugs more affordable for U.S. consumers and patients that we serve. And so we continue to have an active dialogue with the government at many levels. And, we're excited to continue to work with the Trump administration to help reduce the cost of drugs and make them more affordable for every patient that we serve.
But he says he wants to knock out pharmacy benefit. I'm not really making this connection here. You're excited to work with a president who wants to eliminate your entire industry. I get that you want to be optimistic when you're public facing, but it doesn't sound like a good match to me, the pharmacy benefit managers and the Trump administration. How will you convince him that you really are lowering prices?
Yeah, look, I think there's a few things, Matt, to answer your question. First and foremost, the pharmacy benefit management industry has been under pressure over the course many times prior. And so if you think about what we do, first off, we create affordability for consumers at the counter. The average patient today for prescriptions pays less than $8 when they use Caremark. Secondly, one of the things that always comes across is, the PBMs aren't transparent. We've created models. This last year, we launched something called True Cost inside of our pharmacy benefit manager, where we're being 100% transparent with our customers and the members that we serve in terms of driving that transparency. And third, if you think about who uses pharmacy benefit managers, our customers are government constituents. They are Fortune 500 employers. They are, in fact, some of the same pharma manufacturers that put pressure on us, they use PBMs as well to administer their benefits. And so we're excited to show the value proposition that we deliver to the U.S. healthcare system. We lower the cost of drugs. It's proven. And we're excited to show that to the Trump administration as well. And sometimes, let's just be honest, the stakeholders that are driving the prices of drug, which is big pharma right now, they're trying to shift the blame over to PBMs. That's not true.
Right.
If you look at just
Prem, let me just jump in and ask. I spent a number of years living in Germany, and I lived in the UK for a number of years. And I paid far less for my drug needs in both of those countries than I did in this country. Would CVS be for, a one-payer system, or governments negotiating with the pharmacy companies directly? Because it's worked out so much better in other countries than it does here.
Yeah, I don't think that's the answer, Matt. I think the issue that you see is there's cross-subsidization, and the U.S. is paying more than their fair share for branded pharmaceuticals inside of this country. And if you look at the prices in the U.S. for branded pharmaceuticals, they're 4 times higher than other countries across the world. And so part of the issue is, how do we pay the right amount for medications and also afford the innovation that some of these products bring to bear? And so, in that example, we're just subsidizing some of the other countries and the prices that they pay. And, what I think we have to do is figure out how we can continue to create competition and drive that forward. If you think about some of the things inside of our supply chain, generic drugs is a good example. One, the U.S. has the highest generic dispensing rate of generic prescriptions. Those are the lower cost prescriptions,
Prem,
and they are very affordable inside of the
I want to jump here as well.
System.
Sonali here. Good to speak with you today. You made a point a little earlier about how the pharmacy benefit manager system has faced criticism, not just in the current administration, but in prior ones. And there was a suit brought forward by the FTC last year, particularly when it came to insulin prices. They were very clear that they would be looking at other drugs as well. When you think about the tone taken from the agencies, particularly with all the change going on in the current administration, do you think this suit and others that are under the surface may not exist in the same fashion? Do you have any indication that these particular actions would go away, or do they stay just as stringent given what the president has said?
Look, I think there's a couple things. First off, I think that suit cherry-picked a single set of drugs. When you look at the overall value proposition that PBMs bring to the marketplace, our customers get to choose every year who their pharmacy benefit manager is. It's an extremely competitive process. And so, I'm excited to continue to show that data and show, what we bring to the market. And I think we'll work with the administration to show them exactly that, show them, the value proposition that pharmacy benefits managers bring, how we're reducing cost and driving that competition forward for the industry. And, again, in that one suit, you're really cherry picking a few single set of drugs. It's not an accurate reflection of the savings that we provide to all our customers day in and day out.
And Prem, before we let you go, point taken that you're looking forward to working with this administration, but you think about on the lawmaker side, you have some lawmakers wanting to break up companies such as CVS that run pharmacies, PBMs, and insurers as well. Do you see that as a possibility? What would a broken up CVS look like from your perspective?
Look, I ultimately, the 300,000 colleagues that we have serves our country, and they wake up every single day to try to improve the quality of care in this country and to reduce the cost of care in this country. And if you think about our 3 sets of assets that we have, our provider assets in terms of our CVS pharmacy and our healthcare delivery assets, our pharmacy benefit manager assets in terms of how we help drive and reduce cost on pharmaceuticals, and our insurance assets, I'm excited to think about how we integrate those assets, how we help to continue to improve the quality of care, and how we can really drive affordability inside of the U.S. healthcare system. So I don't think that, from my perspective, I think that the integrated value proposition we have is extremely powerful and is going to drive material change that drives and improves the quality of care in this country. And we're excited about what we can bring to bear over the course of the next, upcoming years.
Well, Prem, we really appreciate you taking the time to speak to us today. I hope to do it again soon. That is CVS Health Executive Vice President and Group President Prem Shah. This is Bloomberg. Welcome back to Open Interest. Quick check on stocks right now. You can see the S&P 500 still up about 0.1%, but there's a lot of drama under the hood. Let's take a look at Walgreens. It was briefly halted for its limit up, surging as much as 9% at one point. Trading has since resumed. You can see it's building on those gains, about 10% right now. No clear catalyst for why, no clear news coming across, but we'll continue to monitor this one.
And it's a stock that's been cut in half in the last 12 months, down 50%. Coming up in the next hour, Kristin Peck joins us, the CEO of Zoetis, as well as Mateo Marietti, the co-founder and CEO of CookUnity. All right, we're 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, Bank of America says investors haven't been this risk on in 15 years. Meanwhile, Larry Adam of Raymond James warns that too much optimism may be the biggest risk to markets.
Is CookUnity serving up an IPO? The CEO of the meal delivery service tells us what's in store as competition heats up.
And Zoetis gets a conditional license from the USDA for its bird flu vaccine. We'll discuss the latest developments with CEO Kristin Peck. All of that and more coming up. Let's take a look at these markets, though, before we get there. Small moves overall. The S&P 500 pretty much unchanged, as to is the NASDAQ 100 really giving back those pre-market gains on pretty hefty volume, I will point out. Trading on the S&P 500 about 25% above its 20-day average. Then you take a look at the bond market. We're still above 4.5%. Bond yields higher on the 10-year yield by about 3 basis points, Matt.
All right, pretty interesting moves there. The S&P still trading at 61.15. So that's near the record high of 61.18 on the 23rd of
fragile
January.
heights.
Fragile heights, I guess. Let's talk about this with Larry Adam right now. Raymond James, Chief Investment Officer. Larry, there's so many different signals here. We see the Bank of America survey that shows investors are more willing to take risks than they have been in the last 15 years, judging by their cash levels at the lowest since 2010. On the other hand, Simon White from Bloomberg is out with a great piece today showing hedge funds are shorting the smart money while retail investors are incredibly optimistic, what some would pejoratively call the dumb money. What's your view?
I think there's a lot of optimism out there, particularly on the retail side. I mean, when you look at some of the things that we look at, for the fact that if you look at like the University of Michigan survey or consumer confidence, you have a record amount of people that actually think the equity market is going to go higher over the next 12 months. And historically, that's been a contrarian indicator to at least suggest that you have flattish to slightly down type of markets. When you look at positioning and the fact that retail investors have some of the highest allocations that we've ever seen to equities, when you look at fund flows, when you look at the put-to-call ratio where there's not a lot of hedging taking place on behalf of retail investors, and then when you look at the VIX, you know, that's still at relatively low levels. So I think there's still a lot of uber optimism on behalf of retail investors, and now, as you suggested, you're starting to see it on behalf of institutional investors. So when you have that type of optimism, I think you need to be at least a little bit more cautious here in the near term.
It's incredible. Just 6-7 weeks into the year, really, we're looking at a very different conversation, guys, than we have been. A lot of investors seeing the S&P meaningfully higher. But Larry, you're talking about flattish to lower. A little earlier, Lori Calvasina saying 6,200 on the S&P might be hard to come by. If we are thinking that flattish to lower is the path forward, what gets you there? If you think about an S&P that could actually end the year lower, not higher, what would bring it there?
Well, our official target is 63.75, which again isn't that optimistic compared to a lot of the other forecasts that you see there on the street. But what I think has to happen is you cannot get PE expansion. I think we're at the upper end of where PEs can go. You have to get earnings growth. And our expectations are that you're going to get roughly 10 to 13% type of earnings growth. And that's what's going to have to be the driver of the equity markets moving higher. We also think you're going to see a broadening. And when I say broadening, I do include technology still in that. I just think you're going to see more participation in other sectors like industrials, in healthcare, to really help lift the market. Again, just modestly over this upcoming year.
And Larry, I'm going to do something I never do, and that's bring up Europe. We've been talking about it all show, the fact that you have Europe actually outperforming the Stock 600, outperforming the S&P 500, and, of course, our magnificent 7 names so far this year. Real vibe shift relative to really the last decade. What do you make on that? Can you extrapolate out that people are just worried about U.S. valuations right now?
No, look, I think this is a short-term trade. If you look at RSIs right now, I think that Europe is overbought. So I would look for at least a pause in European performance. More macro speaking, I still like the U.S. over Europe and other international markets for a couple of reasons. Number one, I think you have much better economic growth here in the United States, far outpacing what you're going to get in particularly Europe. That leads to better earnings growth. As I mentioned, we're talking about double-digit earnings growth here. You're going to have mid-single digits over in Europe. And then I think you can't overlook the fact that when you look at technology, you really don't get any technology exposure over in Europe, and you get a lot more here in the United States. And I think that's going to continue to be a critical driver going forward. And then my final point is that we do think you're going to see some tariffs, particularly on Europe. And if we do actually start to see them implemented, I think that's going to hurt that market more so than the U.S. equity market.
I wonder what you think about gold, Larry. I've been pretty fascinated by the precious metal over the past week because of a couple of stories. Right now, it seems like we're seeing a flood of physical gold come into New York from London. But Sonali brought up a story about Goldman Sachs this morning. They're raising their target potentially to 3,300 a troy ounce. Not that it's something you want to be too long, obviously, but how important is gold as a part of an investor's portfolio?
You can have a piece of it as for diversification in case there is any type of geopolitical risk. But I think right now, you're starting to lean to the other direction, right? We're starting to get some calm, if you will, over in Israel. You could potentially see some type of ceasefire with Ukraine and Russia. If you look at what's going on with tariffs, if we have much more of a pragmatic approach where you don't see the negative consequences, I think you could see, less money going into gold. And I would say that over the last 2 years, gold's gone up when inflation has been lower. It's gone up when inflation's gone higher. So I'm not necessarily sure that's the inflation hedge that everybody thinks that it is. It's been more of a sentiment indicator, and with fund flows driving it higher. And if you see any type of fund flow starting to come out of that space, I think you could actually see gold prices move lower over the next year.
Fascinating. If you think about all the risks out there, you mentioned those geopolitical risks, but also that tariff risk, as we've been talking about. Your team has some really interesting estimates on how that might exactly start to impact markets. For example, every 1% increase in the effective tariff rate, your team has written there could be a 0.1% drag on growth. And this is a market that has been addicted to growth. And so if you think about the potential tariff rollover effect, what are you expecting to actually take effect? And how do you prepare investors for that?
So we think the average weighted effective tariff rate, which is at the beginning of this year, is 2.5%. We ultimately think it goes up to about 7.5%. And the significance of that is that I think you are going to see tariffs on China. You're going to see them on Europe. You're going to see them on some of the emerging market economies like India, Vietnam, maybe Brazil. But I don't think you're going to see them on Mexico and Canada. So that's our base case. When you look at how we are positioning, first of all, we thought that this would lead to volatility. So our key message to clients was don't really take the bait and try and take these knee-jerk reactions because you will get whipsawed. As quickly as they can put out a tariff headline, it can be taken back. When it comes to our positioning globally, as we've mentioned, we favor the U.S. over international, particularly Europe and some of the emerging markets, because we think they'll be more negatively impacted by tariffs. From a sector position, we prefer those sectors that have much more of a service orientation and have pricing power, as opposed to having much more of a focus on the consumer, which leads us to favor areas like technology and healthcare, which definitely have pricing power and visibility in their earnings. And then when you look at our overall portfolios, given the expectations that we thought we'd see more volatility, we've kind of brought back some of the horns of volatility. we're focusing more on large cap and mid cap stocks and less so on the more volatile areas of the markets like small caps.
Certainly a lot of investors recalibrating here. Larry Adam of Raymond James, we thank you so very much for joining us to start off the week here in the United States. We also want to take a look at what's moving under the hood here. We want to look at the S&P 500 because, of course, we have been fluctuating all morning, and one of the biggest drivers now is Walgreens. You have a report out from CNBC saying that talks may continue here with Sycamore Partners. Remember, this is an active deal stock, let's call it, up 14% now on the day. Bloomberg News is reaching out to representatives from Walgreens and Sycamore for comment.
Right.
It's been a brutal run for Walgreens otherwise.
Yeah, that is your biggest mover in the S&P 500 right now. Not too much on a points basis, though. And you talk about this brutal run for Walgreens. I mean, this company has seen 3 straight years of double-digit losses. Last year, 2024, down about 64%. It reminds me a little bit of Intel, that traders just want to see some sort of deal here.
I mean, here you see the 5-year chart. It's down 80%. Hard to lose much more value than that. And that includes today's 14% gain.
Can't even see it on the 5-year chart there. So we'll continue to follow that story. But coming up, the U.S. may be moving one step closer to curbing the avian flu outbreak. We'll speak to the CEO of Zoetis next about their vaccine's conditional approval. This is Bloomberg.
Let's get now to high interest. Look at what's making headlines around the world. Ukraine's President Volodymyr Zelensky is canceling his plans to visit Saudi Arabia tomorrow. Zelensky spoke after meeting his Turkish counterpart Recep Tayyip Erdogan. His visit to Turkey comes as top U.S. and Russian officials held talks in Saudi Arabia to discuss ending the war in Ukraine, but they ended those talks and haven't said when they will meet again. Zelensky warns his country will not recognize any agreements that are made, quote, about us, but without us. And Hamas said it will release 6 Israeli hostages on Saturday, as stipulated in the first stage of the group's ceasefire agreement with Israel. In return, they expect Israel to release a proportionate number of Palestinians. According to their Telegram channel, Israel will start negotiations on the second phase of the ceasefire with Hamas as early as this week. Finally, Bloomberg has learned that Elon Musk's government efficiency team is trying to access a broad range of taxpayer data. Democratic lawmakers raise concerns over privacy issues. The U.S. has strict laws that prohibit the disclosure of taxpayer data, with some exceptions for law enforcement. Of course, President Trump himself hasn't released his tax returns.
Well, that's a whole other story. But let's switch gears here and talk about bird flu, because Zoetis has been granted a conditional license from the USDA for its avian flu vaccine. Since February 2022, more than 150 million birds have been affected in the U.S., causing egg prices to surge to all-time highs. Joining us now is the CEO of Zoetis, Kristin Peck. Kristin, it's great to see you in studio, first of all.
Oh, it's very nice to be back in studio with you all.
So let's talk about your vaccine. When might we expect to see it roll out, and how quickly would you expect that to actually show up in the price of eggs?
Sure. I mean, what I want to start with is just really that my heart goes out to all of these, producers, both for broilers and egg layers. They've been on the front lines of this crisis for a while now. And they've been doing everything they can through biosecurity and many other strategies to try to control this. And Zoetis has been standing by and supporting them as we think about biosecurity as well as diagnostics, on farm with them, aligned with our purpose. So we were thrilled to get the conditional license of our AI product for poultry specifically. And just to be clear, this is a conditional license that is up to regulatory authorities in partnership with producers to decide how and when to use. So the sole decision on the use of the vaccine is up to the U.S. authorities.
Interesting. And I'm curious, what this means for your business, because as we've spoken about before, you're more heavily weighted to pets, towards animals that we have in our houses versus livestock. So with that in mind, I mean, depending on the uptake, what could this mean for Zoetis?
For starters, what I think this is a great example is what you and I spoke about at JP Morgan just a few weeks ago, which is the strength of our innovation pipeline across species, where we're expecting, a major approval every year for the next few years, many of which will really be blockbusters in important categories in animal health, such as chronic kidney disease, oncology, cardiology, and antibiotic alternatives for livestock, et cetera. So we're really excited about that pipeline. We think this is a great demonstration of that.
I don't want to get too far away from the avian flu. We spoke with the NEC director, Kevin Hassett, about what's happened recently. Listen to what he had to say.
What are we going to do about the fact that Joe Biden last year killed 130 million chickens, and that's why egg prices are so high? You know, we're putting together a plan to manage the avian flu in a much wiser way.
So he says they were putting together a plan to manage the avian flu in a much wiser way. Obviously, a vaccine would be great for those animals who haven't gotten it yet, but you also make Draxxin, right, which is a drug that I'm not a doctor or a vet, but somehow helps cows and swines with respiratory illnesses. Are there other ways to deal with this problem, or do you really have to, nip it in the bud?
Sure, there's many ways to deal with this problem. And I think, what Zoetis is focused on is supporting our customers with a whole set of tools in order to do this. What I was talking about before is really partnering with our producers to first start around biosecurity, which they're focusing, very intently on. But it is a challenge when a lot of the new spread you're seeing is spread by wild birds. And so you can't really stop the wild birds from flying over your farm. And that is really what is spreading some of the new. We can also focus on better diagnostics to better understand that. There's lots of different tools in the toolbox. Obviously the vaccine is one additional one, and it's aligned with our purpose at Zoetis to nurture the world and humankind by advancing care for animals. And that's a One Health focus, which is, I think, what the White House and the Congress and the USDA has been really focused on.
And not to put the cart before the horse, so to speak, but, when you think about the expansion of the vaccine, I recognize that you still need regulatory approval. But what about other animals? Do you see yourself making one for cattle?
We've really stepped in multiple crises over the years. So we were helping the USDA with a vaccine that they used in their stockpile ban in 2016. As you think about the COVID crisis, we made vaccines that were used throughout wildlife and in zoos and things like that. So we will continue to partner with the USDA to meet whatever their needs are.
I want to broaden out a little bit because you mentioned your pipeline that you have coming up. There's a lot of excitement over renal disease, for example. You think about cats, kidney diseases are really fatal to cats. And like you said, you have big blockbusters expected for the next couple of years. But then you take a look at the stock price. Over a 5-year basis, you're up about 13% on a total return basis. That compares to about 52% for your peer group. So with that in mind, what do you think that shareholders are missing here about the story?
Yeah, we were thrilled to deliver double-digit top and bottom line performance for 2024 and to give an operational guide for this year at the top line at 6 to 8% for organic operating growth. I think there was a little bit of a disconnect with regards to foreign exchange for us, which was $250 million on the top line for us in 2025, $50 million on the bottom line, as well as a divestiture for us of medicated feed additives, which is around $355 million that need to be taken out. So we're working through some of that, which we don't really believe was embedded in the consensus, as we saw last week. But we're really confident that we've got multiple drivers of sustainable growth in what is just a phenomenal industry in animal health, which has been incredibly resilient and durable.
What does the product mix look like? If I look over, just a list of your medicines, I see obviously dealing with parasites is first and foremost. Then you've got like itchy skin problems, right? And then joint issues like arthritis. Are those the three biggest categories?
Yeah, we've got multi-billion-dollar franchises, and the biggest categories where we've been driving double-digit growth. Again, in categories such as paras and dermatology, they've been around for more than a decade. So all of these are billion-dollar franchises for us, the largest being parasiticides. You've got dermatology, where we've been in that market for over 11 years, still last year driving 17% growth. And then in OA pain, where we're really excited about the recent launch in the U.S. of Librela, of Silencia, which has been on the market in international for many years, and adding to that over the coming years in renal, oncology, cardiology, et cetera.
By the way, do you produce all this stuff here? Do you have overseas labs? The strong dollar, is that really an issue for you?
So the good news is we have a global network, global supply chain. Our largest manufacturing sites are actually in the United States. We also have some significant sites in Europe, but the U.S. is our primary manufacturing place for our business.
So the dollar hurts.
Right.
Well, the dollar does hurt. Yes.
Well, to that effect, you're a CEO of a company. You want to focus on your products. You want to focus on your competition. You want to focus on getting new things out there. How much do you have to think about the strong dollar dynamic, particularly with all the tariff threats out there, the ride higher in the dollar?
Look, our focus is living our purpose and meeting our customer needs every day. We certainly are not experts in foreign exchange. So our goal is to deliver for our customers the products and solutions that they need. Obviously, we've got teams who manage scenarios as you think about, for tariffs, obviously. But we don't really manage day-to-day foreign exchange. We focus on living our purpose.
All right, Kristin, that's a good place to leave it. Great to speak to you today in studio. That is Zoetis CEO Kristin Peck joining on the news that Zoetis has been granted a conditional license for its avian flu vaccine from the USDA. Now, still ahead, Nike betting big on Kim Kardashian. We'll tell you about the details of a new partnership made in shapewear next. This is Bloomberg. All right, it's time now for Social Climbers. The company is making waves this morning. And first up, Southwest cutting over 1,700 jobs in its leadership ranks in efforts to cut expenses. It's the first time that the carrier has had to implement layoffs. Southwest also rethinking its famous one-size-fits-all business model. Next up, Coca-Cola is launching a prebiotic soda called Simply Pop. It's taking on upstarts including Olipop and Poppy. U.S. soda consumption apparently has fallen over the last 2 decades, hurt by health concerns and competition from alternatives such as energy drinks and cold brew coffee. And finally, we've been talking about it all show, and that's the fact that Nike and Kim Kardashian's underwear label Skims are teaming up on a new fitness brand geared towards women. The first Nike Skims collection will debut in the spring, and Nike really putting a renewed focus on women athletes as it begins its turnaround effort under its new CEO. And the partnership, good news, Matt Miller, it may even expand into menswear, so soon you too can get some Nike Skims, it sounds
I'm just
like.
not 100% sure on what it is, because we called it shapewear also. So is it just underwear or is it a girdle?
It's not underwear, it's shapewear. So you put it on and, it sort of holds everything together. It's not that you probably wear underwear underneath it, but maybe these are things you should Google.
Yes.
Or talk to a woman, I don't know.
I'll use,
I think
men can wear girdles as well.
Skims clothing on Instagram for the next month. So you finally get it, and I'm going to enjoy it so much.
You're going to send me pictures of people in their underwear?
I
think that would be against policy. I don't believe HR would be okay with that.
Underwear. It's like leggings. It's all sorts of shapewear.
Can you give us a check on the markets?
I would love to. Don't do any of that on your work phones. Let's take a look at these markets right now. The S&P 500, we're actually unchanged still, but the color is red, so some movement there. Now it's green. You have more direction when it comes to the NASDAQ 100. Your big tech stocks down about 0.1% right now, even with that pop that we're seeing in Intel. And then you take a look at the 10-year yield, that sell-off holding in the bond market right now. 10-year yields still higher by about 3 basis points, Matt Miller.
All right, we're going to talk to CookUnity when we come back. Turning profitable as they turn up the heat on the meal delivery marketplace. We'll speak to the CEO, Mateo Marietti. This is Bloomberg.
This is Bloomberg Open Interest. Let's get a look at stocks moving this hour with Bloomberg's Denitsa Sekova, starting with Walgreens, because, of course, the stocks under the surface today are what's moving the index.
Yes, we saw trading halted earlier today. Of course, the news this time is coming from CNBC, and it's about the company being traded, taken private. Earlier, just a few weeks ago, we heard that it's not happening. Now we hear that indeed it's happening, and we saw a surge of as much as 14%. Of course, Walgreens has been struggling amid declining pharmacy reimbursements, competition from online retailers, and the talks about taking the company private has really revitalized the stock, where we saw so many cost-cutting measures that really a sign of the times is that they removed their dividend after 92 years. So, of course, those talks are very shaky, but that could potentially bring more optimism for the stock.
Yeah, we actually reported a few days ago as well that they hired Perella Weinberg Partners here and Alex Partners alongside another company to get help. So we knew that deal activity was probably coming.
Taking out your dividend after 92 years is rough, right? I can imagine the conversation with my broker. Like, no, they won't cancel their dividend. They've been paying dividend for 92 years.
Yeah, that is a tough pill to swallow, I'm sure, for a lot of investors. And I mean, Walgreens, it's basically a penny stock at this point, so it'll be interesting to see if we get some movement there. Speaking of deals and potential deals news, let's talk about Intel also popping in a big way today on some speculations.
Yeah, a great day for Intel after another amazing week. Last week was the best week in 25 years. We're seeing two different deals, one coming from TSMC, one coming from Broadcom. Bloomberg, of course, reported about the Broadcom one. One is looking into more like the chip making business. Other is looking more into the marketing and chip design. So this big company will obviously be broken in two. We know the company has been struggling for some time. So of course, it was a very important big leader, but
an American icon.
An American icon, indeed.
Yeah,
and it
really
still
hard
is.
to push that.
It still is, but of course, artificial intelligence is changing the name of the game, and Intel has been caught up into that. But now we're seeing a lot of optimism. Analysts, though, are warning against the same thing with the deal. A lot of the talks are preliminary. There is nothing put on paper, and in fact, Intel hasn't heard too much about it. So it's too early to be too excited about it.
But it stocks up in 5 days. Is this 5 days? 32%.
That was 5 days.
Wow.
Well, we were talking about last week, the best week since 1982. That's crazy.
Yeah, especially for a stock like Intel. That was its heyday.
Broadening set of partners. I think that's what's exciting about it.
DraftKings.
Oh,
I want to bring up
love this story.
The D King. Price target raised at Truist. Price target was raised at Piper Sandler. Price target was raised at Stifel this morning. Price target was raised at Citi. And yet, the stock is down 4%. What's going on?
Yes, I mean, we're coming off a strong rally from the earnings. Just remember, after the earnings, they had a 15% jump. So it's coming off of a strong start. We actually saw a few more upgrades. We saw Oppenheimer, we saw Northland, and everyone is saying outperform, $60, $68. So there is a lot of optimism in the air. Earlier in pre-trading, there was more optimism on the stock, so potentially we can go from there. When it goes to the CEO, he's saying that obviously legalizing more sports betting is a long-term boost to the company. We know that this season wasn't the best one for DraftKings, so potentially this is where some of the negativism comes. But going forward, all those upgrades should mean something, there is a lot of optimism about the stock.
Remember, not a profitable company, set off another borrowing wave today. Largely, investors have liked it, even if it's not for today.
Oh, you're talking about the company borrowing,
yes,
not
exactly.
destitute gamblers borrowing to fuel their addictions.
That might be happening as well.
We don't recommend that.
It's always good to deal on addictive issues. All right, Denitsa, you may want to stick around for this. Denitsa Tsakova covers cross-asset for us, and I've got a great guest who wrote an incredible column. I love the title. Simon White says, when hedge funds are hedging, it's time to take note. When they're actually doing that.
Right, offering that diversification.
Exactly. Let's bring him in right now because, Simon, we talk about the difference between the dumb money and the smart money, dumb money being a pejorative term for retail investors, smart money, I guess investors hope, hedge funds and institutions. Are they going in different directions?
Yeah, I mean, we had last year, everyone was kind of universally long. So hedge funds were not doing, as you say, maybe what you'd expect them to do. And retail was long and everybody was long. And today you've had the Bank of America's Global Fund Manager Survey that's saying that investors are long in totality. But it looks like hedge funds are getting shorter. So Goldman Sachs had some data showing that the shorting of single stocks by hedge funds was 2-year high. But also, if you look at the hedge fund research, publish a number of hedge fund indices, and many more of them are now moving negatively within the market. So that suggests that funds are getting more short, but the retail is still piling in.
You know, it's interesting. I took a look through the 13F aggregate data and was pretty interesting to see that of the buying you saw in aggregate from all investors, you did not see the same type of excitement around certain sectors as you did from the hedge fund industry. And I'm wondering if this is because so many trades have already been so crowded. The dry powder has been used and the leverage has been maxed out. How much of this is a need to become defensive?
Yeah, that's definitely true. I mean, when everybody's long, there's only one way to go. If you look at across the whole sectors, right, the household sector, financial sector, the banking sector, they've never been longer relative to financial assets, US equities, and the rest of the world as well. So really, there's certainly crowding in US equities. There is all manner of risks that we're well aware of. I mean, even in the last few weeks, we've of course had DeepSeek, we've had tariffs, yet the market's still managing to scrape together, and it's near all-time highs. And that's not to say it couldn't do the same again. Really, it's the wall of worry, and once it climbs it, we could see, more strength. But really, you've got so many headwinds. You've got excess liquidity is falling. You have, as I say, the overvaluation and the over-ownership of stocks, plus the fact you've got index correlation doesn't really get any lower. And that's a real source of potential risk, because if people have to start unwinding dispersion trades where they have to start buying volatility, correlations could suddenly rise very rapidly, and you're looking at a very different market. So it just seems that your risk reward here for owning equities has gone down, and maybe that's what hedge funds are thinking.
Simon, this is more of a comment than a question, so I apologize in advance. But to me, it always seems like positioning is kind of an inkblot test, because you can look at hedge funds, they're doing one thing. You can look at the Bank of America Fund Manager Survey. Apparently, people are the most risk on since 2010. And then you can take a look at money market funds, which still have $7 trillion in them. And then you take a look at the ETF flows, and there's just money continuing being thrown at equities. So it feels like wherever you look, there's different stories there.
Yeah, that's absolutely true. I mean, you've got numbers of different metrics. ICI do metrics, ECRS, and sometimes they say different things. But from what the things I looked at in today's column that you referenced, I'm beginning to see a more clearer picture in that you really are seeing retail, they're not really pulling back at all. ICI's number for mutual funds and ETFs was a $200 billion annual rate, which is about as high as it's been in the last 10 years. And there is real data showing that hedge funds are starting to do the opposite. So I think that's the information content. You don't blindly follow the smart money, but when the smart money is going short and retail is still piling in as today, that tends to coincide with market weakness.
All right, Simon, great having you on to talk about today's macro scope column. We're going to have you back to talk about gold, because I think that's also a fascinating story that you've been reporting on as well. Simon White there in London. Coming up, CookUnity turns profitable. The CEO of the meal delivery service tells us what's in store after 90% growth in the past year. This is Bloomberg. The first chef-to-consumer meal marketplace is cooking up a winner. CookUnity, which began 10 years ago, is now turning a profit after seeing 90% year-on-year growth in 2024. The company sets up a Toronto service this May, which means it'll be expanding beyond these United States. Joining us here in the studio is Mateo Marietti, CookUnity CEO. Great to have you in the studio. Thanks so much for joining us.
Thank you for inviting me.
I got from a Spanish VC, one of my cousins, a CookUnity box a couple of weeks ago, and we were just shocked at the quality of the food, how long it lasted, how much our kids ate of it, and I had never heard of it. So tell me about the business, how it's grown, and why it's only in the U.S., and I'm getting turned on by a guy out of Madrid.
Well, I mean, that last part, maybe we leave it to just pure luck. But we started in the U.S. because this is a very big market that I think has a need for a new solution for food. I think people are very busy and not always prioritizing their food choices and their health. And we are doing something very traditional and something quite revolutionary. The traditional part is that chefs are cooking your meals, and that's why they taste like that. They feel so premium. But the revolutionary part is that we are investing in technology to enable them to do their craft.
I want to talk about the more boring part. Matt and I love to cook, we love to eat, we love to try new things from chefs, but what about cost? At the end of the day, how do you pitch to customers that this is something to do versus going to the grocery store and doing it yourself, particularly for that busy customer? We were talking about it in the commercial break. A lot of people are looking to services like yours because there isn't enough time in a day.
But how much is it?
Yeah, but how much is it? And does it save you money relative to the grocery store?
So the plans start at $9.99. And they go as high as $20 for ingredients like lobster, wild-caught salmon, duck, because chefs want to be creative and want to cook with all the ingredients that they love.
This is what, per person per day?
Per meal per person.
Yeah.
So meals are individually portioned. We're introducing a lot of new product lines, so larger sizes, kids meals, appetizers, protein onlys. But basically the cost is like cooking yourself. If you're buying from scratch, great ingredients, cooking, sometimes it's hard to keep up with waste recipes in a household. So the efficiencies come from a lot of economies of scale. CookUnity is doing over 50 million meals a year. A lot of chefs sharing the same kitchens. We have kitchens around the country where the chefs bring their teams to cook in batches because customers select their meals once or twice a week, and we can deliver several meals at a time versus ordering last minute delivery from a local QSR or restaurant that usually has a lot of fees and higher prices.
I mean, for what it's worth, too, $10, you're getting a salad in a New York City restaurant for more than $10.
Oh, absolutely. Yeah, it's just crazy, the prices that are being paid right now. And it's interesting to hear that stat that you're starting at about $10. But building on that price conversation, I mean, the price of eggs is ridiculous right now, and it seems to be only moving higher. You have other idiosyncratic things as well when it comes to cocoa, for example. And with that in mind, have you had to adjust prices, or what does that decision tree look like when you have all these different ingredients just being so volatile?
Yeah, so two things. The service started in 2018, so viewers can have a reference of our journey and what situations we had to face. The only price increase that we did was in 2021, 2022, when inflation was sticky and prolonged. Right now, we're not raising prices if one ingredient or there is volatility on a few things. Of course, if there was a more sustained inflationary process, we will have to do it eventually. But we're benefiting from growing very fast, so we can, on our turn, buy directly from farmers. And so far, that has worked really well for us. And we didn't increase prices in the last 2-3 years.
If you have this kind of growth, right, we said 90% year over year, if you're turning a profit, if you're looking towards international expansion, I would think an IPO is on the near-term horizon. Is that a good way for you to finance this kind of growth?
I think it is. We don't have a specific timeline, but we're definitely preparing for it, putting the company with the best practices. I think transparency is a great thing, both for our team internally. I also want all investors, retail and institutional investors, to know what we're doing to support our community of independent chefs. I want the chefs themselves to be able to own stock if they want to, but what's important to highlight is what we're doing is revolutionary for the chefs, because chefs on average in CookUnity are making more than $700,000 a year in their own income.
I saw a number of chefs have become millionaires,
annual
millionaires.
With the bestseller chefs making $4 million, $5 million a year. That is unprecedented for the culinary industry. So that's one of our motivations. And the second one is people stick and spend more year over year because this actually solves a real problem for them. So I think the public markets will receive it well. Right now, there is a lot of conversation about healthy eating. I'm proof that the product works. I have 3 kids, all young, 7, 4, and 2. I lost 25 pounds since I started this company. So I think that would be a good phase for the company.
Well, you look great, Mateo. And let's build on the IPO conversation, because an IPO would be one route. But I'm curious whether you've thought about acquisitions, maybe being acquired yourself. You think about Blue Apron, for example, a competitor of yours in a broad sense, being acquired. Is that something that you've thought about?
No, we haven't put any thought into that. We are trying to build the world's best and biggest marketplace. We want to do for food what Spotify did for music. We want people to open an app and the best content of food, meaning chefs, recipes, cool. Dishes are available there. So we have a really long journey ahead of us. We're just getting started, so no, that's not an option.
So on your website right now, you're offering a promotion. It's get 50% off your first week, 10% off the next 3 weeks of dietitian-backed meals. Good promotion. Is this part of your journey to go public, to add a lot more subscribers, to give the public markets the biggest possible subscriber base?
Yeah, look, we have awareness below 10% nationwide. So I think that even if we're growing at 90% now, even if we sustain that for 2-3 more years, the penetration is still less than 1%. So in terms of the opportunity here, we were very early. So we see, as far as customers love it, as far as customers stay longer and spend more over time because we keep adding more recipes, more product lines, adding new customers is important, but not our main priority. But of course, since we became profitable, we are spending more in awareness, in marketing, and it's working.
Mateo, great having you on the show. Hope you come back.
Thank you so much.
And join us again. Mateo Marietti there of CookUnity. It's made me hungry, actually.
You're always hungry at 11.
It's
always.
Fair. That's fair. Coming up, top officials from the U.S. and Russia have wrapped up a 4-hour meeting in Saudi on ending the war in Ukraine. We'll bring you the latest on that. In the world of politics, this is Bloomberg.
The U.S. and Russia wrapped up over 4 hours of negotiations in Riyadh today. They agreed to more talks on resolving the war in Ukraine, but did not set a date for a meeting between the country's two presidents. And Ukraine's president, Zelensky, canceled plans to visit Saudi Arabia Wednesday. Joining us now in Washington, co-host of Balance of Power, Kayleigh Lyons. Beyond him canceling his trip to Riyadh, the fact that he was also left out of the conversations as they currently exist, how is this falling out among not only the relationship between the U.S., Ukraine, but their broader European counterparts as well?
Yeah, it's not just Zelensky that's on the outside looking in here, Sonali. It's those in other European capitals as well who had to convene their own summit in Paris yesterday for talks on the way forward here. That said, the talks in Riyadh that were just taking place between U.S. and Russian authorities did yield some progress. As you mentioned, they agreed to continue peace negotiations to bring an end to this war, according to the State Department, as soon as possible. And they will restaff their respective embassies in Washington and Moscow in order to continue that work in part. Another interesting outcome here is that the U.S. and Russia have committed to expanding their economic partnership ultimately when this war is over, which really just speaks to the different attitude this Trump administration is taking in relations toward Russia compared to the first administration, where it was Biden-era policy to not have any direct talks with Russia unless Ukraine was involved. And that really is the biggest storyline here, is that Ukraine was not at the table today. Volodymyr Zelensky didn't even know that these talks were scheduled to happen. He said it was a surprise to him, and made it clear that Ukraine will not be agreeing to any deal that was negotiated without them included. Now, his cancellation of his trip to Saudi Arabia tomorrow is noteworthy. As we understood, he was seeking a readout of the talks that took place earlier today from the Saudis, so he may get that elsewhere. And I would note that Keith Kellogg, who also was not present in Riyadh for these negotiations, even though he is the special envoy for the Ukraine war, is going to be in Kyiv tomorrow. So perhaps we could look for more discussions that will happen then.
You know, I think back, Kayleigh, to Trump's first administration and his urging of our European partners to spend more money on defense. A lot of them, agreed that maybe it would have to happen, but few of them really raised the money and did it. Now it looks like, 8 years later, they realize it's high time to support NATO financially in a much stronger way. Is that one win that the White House is getting out of this?
Well, potentially, Matt, if it actually elicits behavioral changes from European allies, who Donald Trump has largely viewed, at least some of them who haven't traditionally met that NATO threshold in terms of defense spending as a percentage of GDP, will do so more. Donald Trump has obviously floated that he thinks NATO countries should be paying 5% of GDP. Ultimately, that isn't a target that's necessarily realistic for all of the countries in the alliance. I did speak earlier this month with the Lithuanian foreign minister while he was here in Washington. Lithuania has committed to 5% GDP level by 2026. And when I asked him, is that realistic for everyone in the alliance? He said, no, everybody's going to be different. So clearly each country is going to have to take their defense spending approach differently depending on their financial situations, which is why there's a conversation now of whether or not it's going to take issuance broadly from Europe. If Eurobonds are actually going to have to be involved in this equation somehow, if there is going to be a ramping up of defense spending to compensate for the loss of what Europe has been relying on for decades, which is a strong U.S. presence in many of these countries in order to counter Russia. Clearly, this administration is not being shy about signaling that there is going to be a certain degree of pullback in terms of the U.S. presence.
All right, Kayleigh Lyons, all over the latest. Of course, you can catch her on Balance of Power. Our thanks to Kayleigh joining us from Washington. Let's get a check on these markets right now. Not too much movement at the index level. The S&P 500 higher by about 0.1%. You can see the NASDAQ 100 flipping into negative territory right now. A lot of action if you look under the surface, though. We've been talking about Intel. We've been talking, of course, about Walgreens, both surging today. There's a lot of speculation about deals when it comes to both of these companies. We'll have to see how that develops. But you can see that traders, you guys, not waiting for details.
And, Meta falling falling more than 2.5% today after a significant winning streak.
The streak is over and then some.
Streak is over, and
it's the biggest weight on the S&P, right? Or at least one of the top 2 biggest weights on the S&P. I know Intel is one of the top 2 biggest lifts.
Yeah, Intel and NVIDIA up about 0.8%, but that's good enough to be the biggest points contributor when you're that big, Matt.
Coming up tomorrow on Open Interest, David Leibovitz joins us of JP Morgan. Joanne Feeney joins us from Advisors Capital. And we get Diane Swong from KPMG. It's a show you don't want to miss. We'll see you then. This is Bloomberg.